getting back to lecture 1. Page number 37. Lecture notes, page number 37. I think this is where we stopped. Wasn't it? Yeah, all right. Thank you. Valuation approaches. What do we have? Three families of valuation. One is DCF. Two is relative valuation. The last one is contingent claim valuation. Then DCF relates the value of an asset to the present value of expected future cash flow. We're going to spend the half of our semester on this one. Okay. And your corporate finance element will be covered over here. Relative valuation is estimating the value of an asset by looking at the pricing of comparable assets relative to a common variable like earnings or book value or signing a deal, right? Third one, contingent claim valuation, is applying option valuation technique, okay? Option pricing technique, call option, put option kind of things. We are not going to cover contingent claim valuation. It's more for advanced corporate finance or option pricing classes, right? Which is called the real option. I'm going to talk to you a little bit about it, but basis for all valuation approaches in an efficient market, the market price is the best estimate of value. You cannot observe the value, okay? Just estimate it. Okay? The purpose of any valuation model is then the justification of this value. Okay? The use of valuation model in investment decisions are based upon perception that markets are inefficient and market makes mistakes in assessing value. An assumption about how and when these inefficiencies will get corrected. Okay? Those things are needed. DCF valuation, okay? This is your basic finance 101 thing. Value is nothing but the discounted cash flow. Task for you is to estimate or have some expectation of future cash flow and then discount it at relevant discount rate. Okay? So every asset has intrinsic value that can be estimated based upon its characteristics in terms of cash flow, growth, and risk. So economic fundamentals. What's the fundamental? Right? Your value, and then the intrinsic value has to be it, right? So that's the idea. And then here, the analyst, right, using this technique, typically assumes the market is inefficient. Samsung Electronics or whatever stock that you value, okay, maybe most probably mispriced somehow, undervalued or overvalued. The price right now is not reflecting the fundamentals. That's why we recommend buy for this stock, right, or sell this stock, right? Market inefficiency. The framework in a diagrammic form, it looks like this. You're going to see this many, many times. I'm not asking you to do this right now, but the first thing is that, just project your future cash flow, but the first step, what's the cost of equity or cost of capital that you're going to use to discount this future cash flow? First step, discount rate. And the second step is, the cash flow over time. You have to project it. And then, at some point, you will assume that your cash flow will stop growing fast and stabilize somehow. Typically, people come up with this kind of timeline of your cash flow. Time 0, you are standing over here. Hello, right? Future cash flow, and then after a certain period of time, we don't know when it is, but it's going to be stabilizing, just like a life cycle, or thinking about your height during your high school days, how fast you were growing, and then after certain period, you will be stabilizing in terms of growth, right? So the question later becomes, when should you assume that this fast growth, maybe 50% growth per year or something, will stop and then stabilize, maybe GDP growth rate of 2% or something? When will this happen? Will be your question. Does it have to be 5 years, 10 years? We don't know. It's up to you. Totally at your flexibility. Okay? When you're valuing an established company in a saturated market, okay? 포화 상태, red ocean market, right? In Korean terms, right? Red ocean company. You're not going to have 50% growth anyway. Okay? In that situation, perfectly fine to assume a one-stage stable growth model over the infinite horizon. Simple, the cash flow projection gets really simple if you assume this kind of growth rate. Okay? In that case, don't try to overcomplicate the situation. Simpler model takes you longer. Right? So people sometimes make this mistake, right? We assume the fast growth rate over the next 10 years, and then it will stabilize afterwards. So stable growth rate, 2%. Fast growth rate, 2.5%. What's the difference between 2.5% versus 2% over the next 10 years? Just work with 2%, right? Okay? That's just perfectly fine. So that's that. Terminal year, this one, okay? People come and ask me, is it safe to assume 10-year, 5-year, 7-year? Please tell me. No, I'm not going to tell you. You determine which one. Okay? It's up to your scenario. It's just perfectly fine. Okay? So that's that. DCF valuation, by the way. We're going to go through it much more in detail throughout the semester. DCF valuation. If it is done right, it's based upon an asset's fundamental economic fundamentals. It should be less exposed to market moods or perceptions. Psychology is not that much affecting this, hopefully, right? If good investors buy businesses rather than stocks, right? Discounted cash flow valuation is the right way to think about what you are getting when you buy an asset. Well, think about what Warren Buffett says, right? He say, I invest more. When I invest in a company, I buy the company. I'm not buying just a stock and then become a day trader, buy and sell, no. Value the company with the fundamental information, do the DCF correctly. For that part, you have to have a good understanding of the company. Right? Make sure all those things happen, and then once you value it, and it turned out to be good investment, buy it and hold it for how long? Or hold it for about 5 years, 8 years, right? Because the market is inefficient, the company may be undervalued, underpriced right now, but hold it, buy and hold it for a long period, it will eventually converge, right? That's the idea for that, especially for the DCF valuation guys. Right? And the DCF valuation forces you to think about the underlying characteristics of the firm, economic characteristics of the firm, more thoroughly. Right? Why do we spend so much time on this DCF half of the semester on this one? Well, because of this one. Right? Try to understand what is going on in this economic way, right? Fundamentally. Right? And then also, the DCF valuation is, how do you say, less affected by the market mood, I said, right? So when the market is in bubble, internet bubble period in the early 2000s, right? Warren Buffett was warning, right? All the stocks seem to be overvalued. I'm not going to buy anything. And then just hold for cash and then don't try to hold anything. That's something you can do, okay? Try to stay away from the market sentiment. Okay? That's one advantage for you, okay? Disadvantages of DCF valuation is also there, okay? More complicated model you will use, right? As I said before, more complicated is not necessarily better. right? So it may be requiring far more inputs unnecessarily. So watch out for that. And then these inputs information are not only noisy, but can be manipulated by the savvy analyst to provide the conclusion he or she wants. I told you that the DCF valuation could be, how do you say, safeguard you against market sentiment more than relative valuation. But still, when you're punching in the numbers, you'll still be biased somehow. Okay? And then those sentiments get into your mind, you cannot just help it. Okay? So that's the point here. Intrinsic valuation model, there is no guarantee that anything will emerge as under or overvalued. Thus it is possible in a DCF valuation model to find any stock in a market to be overvalued. This can be a problem for equity analysts whose job is to follow sectors and make recommendations on the most under or overvalued stocks in that sector. Equity portfolio managers who have to be fully invested in equities. So if you're Warren Buffett kind of guys, then the market is also in too much bubble, then you can recommend sell all those stocks. But if you're hedge fund managers or mutual fund managers, you have to hold some stock anyway, right? You cannot just liquidate all your stocks and hold cash 100% as your portfolio. You'll be punished, right? You have to have some stocks over there. In that setting, DCF will be like silent, okay? In that setting, relative valuation will be more helpful. That's what I'm trying to say here. Some professions or significant part of the portfolio management business, you have to hold some stocks there, right? For that part, which one is relatively more overvalued versus undervalued, that's important. The DCF will be, a bit helpless in that setting. Okay. When does the DCF valuation works? Well, to be able to understand a company, right, and then you need to have some precise information, historical track record of the company, right? So if the company has 100 years of history, right, like Coca-Cola, and then the company is easier to understand, simpler business structure, okay, and longer history, track record, okay, then you can build up, you can have a good understanding, solid understanding of the economic fundamentals of this company, right? So that the DCF valuation will be working good for you, right? On the other hand, that means if the company has short history, it's a startup company, holy cow, is there any disclosed accounting report? Anything? Audited accounting report is really hard to get that, right? In that situation, DCF will not be helpful for you. Okay, long history is good for DCF. It works best for investors who either have long time horizon, if you have the luxury of time, right? Waiting 8 years, 5 years. At some point, Warren Buffett was investing in Daegu in South Korean company, right? And it held it for like about that year, like 5 years or something, I think. POSCO at one time he was holding it, right? For a long time. If you have that long time horizon, if you can sustain it, then you should go for it. Okay? And then it's also good when you have the means to influence the management, which means kick out the CEO and then place your friend over there. Not the average friend of you, but some of your acquaintances who is good at management, right? Competent CEO. If you can replace the bad CEO with good CEO, right? Then this is the right thing to do. Okay? Right. Activist investor, that's their job over here. Okay? If you are pissed off with the management, how could that guy be, screwing up the company like that, and then you want to kick out the management somehow. Okay? Those guys who are doing it, activists and investors. Who is a good example? activist investor. Our recent example in South Korea. Last year, what happened in Samsung-Mulsan? And then 제일 뭐지? You remember? 제일 Industries and Samsung-Mulsan? Who was getting in there as activist investors to stop the mergers, please? Who was it? Elliott, right? So foreign investors, foreign institutional investors can sometimes work as activist investors. Our domestic investors, institutions also work as that, right? 장하성 fund kind of guys. Activist investors. They use, DCF valuation much more, right? And then they are more likely to be long-term investors. The media sentiment, right? The 한국경제 kind of guys, right? They were writing a news article saying that these Elliott and foreign investors are short-term oriented, and then myopic investors, bad guys, and that they are irresponsible. They're criticized like hell. If you raise your hand for this, foreign investors, you're bad guys. You are not being patriotic. They were painting as a bad guy. But as it turns out, foreign investors, like Elliott, they are more likely to be what? Long-term investors. They are more dedicated. Okay? That's the funny part of our corporate governance in Korea. Okay? So don't be misled by media. Okay? As it turns out, the 한국경제's 주필, who is that editor, is how do you say? Outside director of Samsung-Mulsan, which means close friend of what? 이재용 or somebody, right? That's why, the media, don't believe the hype, right? Now, relative valuation, on the other hand, looks like this, for example. Okay? Valuing an IPO, for example, looks like this. Let's say you're trying to value a private company that's about to launch in the market, IPO, right? What is IPO? Initial public offering, right? You started a company as a private company, your mom and pop store, okay? But luckily grew and expanding your business, you need more money. Where would you get money? Well, by launching into the stock market, debuting in the stock market. And then the general public investors will put their money in your company. That's the IPO process, okay? So that your company will be traded in the stock market, just like Samsung Electronics, hopefully, right? So that's the IPO process, okay? And then in that part, you have to value how much should be the fair price for this IPO stock, okay? How much should it command, right? Should it be traded, okay? How much should the investor put their money per share? Well, that's your job as an investment banker in IPO business. And then this industry tells you that typically the stocks in this industry is traded at 24 times PE ratio, right? So how much should the new shares be priced if the current earnings is $1 per share? 1.04. How did you come up with that number? The earnings per share is 1, which PE multiple. So you stick in your EPS, earnings per share, and then this is what? What is the PE multiple? And then use this thing to figure out the price, fair price that you should command. So the average PE ratio in the industry is 24. What should be your fair price? You agree? You don't understand this part? All right. So the assumption is this: PE multiple, right? On average, the market PE multiple, average PE multiple is efficiently priced, efficiently there, right? In the same industry, if you belong to this industry, your company's PE multiple has to be 24. Okay? You just don't have price of your new company in the IPO setting right now. Okay? You don't have PE price for your company, but you have earnings figure, EPS figure. Okay? This is X. This is 1, and then as long as your company is efficiently priced in the market, your PE multiple has to be 24, right? So it's like solving equation for X. Make sense? So the P unknown should be 1 times 24, that is 24, right? Right. So that's that, okay? Second question is, what will happen if you remove the 2 firms with the lowest PE ratio in the same industry? So the average could be driven by, you said about 24, right? Yeah. The average, did I give you already? The second time, long day. Could have been a lucky day for you, but right. Right. Because the average could be driven by outliers, exceptional thing. Let's remove these outliers and then see what's the more reliable number. Right? So that is 26.71. So based on this, 2 numbers, what should be your fair price? 20? About 7, right? 26.7. Yeah, right. That's the thing, right? The relative valuation, right? The value of any asset can be estimated by looking at how the market price is similar or comparable assets, right? Did I tell you about the apartment story here? No? Apartment unit? So, it's like this. When you're valuing your apartment unit, how would you value it, right? If you try to go like, my toilet bowl will generate, $20,000 per year, hopefully. I don't know what's happening in your toilet bowl, but $20,000 every year. My bedroom window will generate maybe $40,000 per year, and then try to aggregate all those kitchens and then all the components together and try to value your apartment. Your boss will say what? Get out of here, right? You're going to be fired. What's the best way of valuing your apartment? Exactly. Right. Check the other apartment units, right? Similar size, similar design apartment, neighborhood. How is it priced? That should be your fair price of your unit. That's it, right? Similar idea. How should I value my company? Look at your neighbors, right? Similar company, similar characteristics, similar industry. How is it priced? And that should be your valuation number, right? Well, the market cap or the market value or the whole size of the companies may be different, but if you divide those market price by some common denominator kind of things, then you will end up with some measure that could tell you what has to be the fair value of the company, right? So it's assuming the market on average is efficient, right? Market is efficient. In contrast, DCF, you are assuming the market is inefficient, right? Inefficient. Here, on average, you're assuming that the market is efficient. So, for example, at any given point of time, let's say this is PE multiple. We said this is 24 before, right? Easy number, 24. All the stocks will be located somewhere here. Okay? On average, this is, data fairly priced, efficiently priced. Some stocks may be deviating away from this, which means this guy may be inefficiently priced. This guy inefficiently priced. Underpriced, overpriced. But over time, these guys will converge to efficient level, right? Quite in a short time horizon, right? Maybe in a month or two, or maybe in 6 months, or I don't know, but it's going to converge quite quickly. And then, on average, the market is efficient. That's the idea. So, overprice the stock, you sell it. Underprice the stock, you buy it. That's the idea. Also, when you don't own a stock, but that's overpriced, what should you do? Short sell it, right? And then this guy still buy it. So over time it will converge. You know what kind of trading strategy is this is called? Long-short portfolio, right? Longing on underpriced stocks, shorting on overpriced stocks, right? Relative long-short portfolio, hedge funds' favorite technique. And right, so that's that. Advantage of relative valuation. It's more likely to reflect market perception and moods than discounted cash flow valuation. By definition, right, we are assuming the market is efficient, which means there's no such thing as market-wide bubble or burst. Okay? It's only about relatively more bubble or not is the issue here. So if the overall market is in a whole bubble, this model is rather silent. Okay? So you have to be careful about it. Even though some of your stocks may be undervalued based on relative valuation, it could still be overvalued if the whole market is in bubble. Okay? And vice versa. Even though some of the market seems overvalued, overpriced, it may still be undervalued if the whole market is tanking. Right? So that's something you have to be careful about. Right.
You said that it's indecisive. You said that indecisive is less reflect to market perception.
Right.
I think indecisive we have to choose cash flow and growth rate.
Right.
I think it could reflect.
Yeah, that's what I said. Even though the DCF is less affected by the market sentiment. Here, the relative valuation is totally driven by the, could be drifted away from, fundamentals, so much so that even though you are in a complete bubble, you just don't realize you are in a bubble. And you can say that you can do a mistake like this. But in DCF, you are less likely to suffer this kind of problem. Still, you're right. That the inputs that you are punching in, when you are punching in, you will have some bias there. That bias will be driven by some of the market percentages still. Right? But what I'm trying to say is that compared to relative valuation, is safer in that sense. Okay, that's all. Right. Good. One chewing gum because you helped the other people too, right? And then, what else? Relative valuation, much more likely to reflect market perception and moves. The objective is to sell a security at that price today, investing on momentum-based strategies. This can be an advantage, right? Right. And then with relative valuation, there will always be a significant portion of securities overvalued or undervalued. So if you are equity portfolio managers, mutual fund managers, or hedge fund managers, you just have to have some equities anyway. Okay? You just have to have some risky investment. You cannot cash everything out. Right? In that sense, relative valuation will be helpful for you. It gives you an idea of which one is relatively less, underpriced. Okay, you hold those stocks, and then portfolio managers judge based on relative performance benchmark. For this part, relative valuation will be helpful if you are holding on to certain industry stocks, right? Industry securities compared to the benchmark. How is your portfolio performing? Okay, in that setting, relative valuation will be helpful. And then relative valuation requires less information than DCF because all you need is just these multiples and then and then figure out where you are. valued in aggregate, relative valuation will fail. And then relative valuation may require less information, in which most analysts and portfolio managers use it. But every now and then, people come up with their own creative multiples. PE multiples have been surviving for long. But over time, people have been inventing new multiples, and then scare you like hell, right? And as if they are the star with their own created multiples. For example, price per eyeballs. What do you mean eyeballs? My eyes, your eyes, right? How many people are watching this internet site, right? How price per click? How many eyeballs are watching it? And then the numerator is the price of the company, okay? Price per share of the company. They come up with this kind of measure. Your job is to discern whether this new multiple is making sense versus not, okay? I told you, like, a lot of bullshitting goes on in the financial market anyway. Your job is to discern those things and then punish them. Discard those things. So that's the hard part. It is the hard part. Some multiples are not consistently defined. You're going to talk about it after midterm exam, but some problematic things you will learn about it. Now, Google versus Apple multiples are shown over here. I pulled it out from Yahoo Finance, right? Still, Yahoo Finance is a good source when you try to extract the historical stock prices or index values, right? Compared to Google Finance, still, right? They're surviving there. What kind of multiples do we see? PE, PEG ratio, and then price to sales, price to book, enterprise value to revenue, EV to EBITDA, right? All kinds of things, right? We're going to learn all these things after the midterm exam. Okay? When relative valuation works best, when there are a large number of comparable assets, comparable companies. Okay? The larger number you have, it's kind of law of large numbers, right? So the large number of comparables, you'll have more confidence in telling the efficient level of valuation. Okay? And then these assets are priced in the market. Yeah, you need some market price as a numerator, market price somehow. Right? And then there exists some common variables that can be used as a denominator, standardized value. Right? EPS, right? EPS, where is that? Right here. Okay? You need to have those things. Trouble comes when this figure is not available. Not all companies have positive EPS, right? Sometimes it's just 0. You divide anything by 0, that's a good way of exploding the number. Right? And when the EPS is negative, you cannot use it. Negative EPS, what does that mean? 100 times minus. But people still use it by mistake, right? So you have to correct those mistakes. Your boss may be making mistakes. You have to tell him, sir, right? That's wrong, okay? You have to, So that's what Andy Kim told us. Go and, check with him. Right. This approach tends to work best for investors who have relatively short time horizon, like hedge fund managers, or day traders, right? Or mutual fund managers. Those guys are judged based upon relative benchmark, I told you before, and then those guys who can take actions that can take advantage of relative mispricing. I told you about the relative long-short portfolio. Okay? And then, what approach would work for you? This is just an open question thrown out to you. How many of you, as an analyst, would prefer DCF? Please raise your hand. 1, 2, 3, 4, 5, 6, 7, 8. Okay, relative valuation, please. Okay. It's tilted towards more. Both, please. Raise your hand. Okay. year, people were having more preference for DCF. Okay? And then people were switching to relative valuation later on. But you guys seem to be more informed this time. Interesting. Okay. Fine. One more thing I should tell you is that at the end of valuation project, I believe, right? You will have to choose relative valuation or DCF valuation result. Okay? What are you talking about? Well, your valuation number coming from DCF may be drastically different from the number coming from relative valuation. Holy cow, what should you do? Should you take the average? DCF buy, relative valuation sell, on average hold it. Should we do that? Yes or no? You said no. Okay, make sure you say no, right? At the end of the semester too, so that you have to choose one. Okay? But I promise you, you will make a mistake by taking the average of it anyway. The issue becomes like, whose perspective would you take? Okay? Would you be like Warren Buffett? Then go for DCF. Buy. Would you be like hedge fund managers and sell? Then sell, right? Relative valuation, that's it. Don't take the average of these two guys. You will be like, torn apart, and then you will lose some points there. More importantly for this class, okay? I'll make sure I'll punish those guys. So remember. Third part is contingent claim valuation. We're not going to cover this throughout the semester. It's more for the advanced corporate finance class in the name of real option, or covered in the option pricing futures forward market. Okay. But the idea is this: there are some assets called call option and put option and exotic options, right? What kind of things? It's kind of contract. It's a contract, and it is a right to exercise. It's your right. You can choose not to exercise and choose to exercise. Okay? But that kind of right has some value, intrinsic value in it. Okay? What kind of right is it? Well, call option, let me tell you a little bit about this. Okay? If there is any underlying asset, okay, and then you make a promise with the other guy, you say counterparty, contract counterparty, me and you, okay, make a contract, and then at a certain future date or certain period, if the underlying asset, for example, Apple stock, okay, Apple stock goes above, let's say, $100 per share, I have the right to buy it at $100 per share, and then you have to give it to me, right? So I am buying call option. What's the payoff to me? Well, if the Apple price per share goes above $100, I choose to exercise. Who will not choose to exercise it? Man, come on. Everybody will exercise it, and then get the share from him, and then turn back to the market, and hopefully I sell it at the market price at that stage. Maybe $200 at this stage, okay? Hopefully. So the difference is my profit. Of course, net of the price of call option that I spent to make the contract with him, right? So that's why we have some negative part over here. But the payoff diagram looks like this. Right to buy at lower price. Okay. It's kind of betting, like betting against each other. Put option, what is that? Well, this time, same Apple stock, right? The right to sell it at a certain promised price. Let's say, again, $100, strike price, and future date, 1 year from now maybe. And then I have the right to sell it at $100. Well, what if the price goes down to $10 or so? Tanking, wow. Then I save my day. That saves my day, right? And the put option seller must be screwed. Well, because I can sell it at $100, whereas if it was, in the market, it must be $10. The difference is my gain. Okay? That's the idea of put option. Call option, put option pricing. You must have heard about Black-Scholes model, which is really complicated. Requires a lot of math there, but those formula is there. Okay, those formulas are there. Call option versus put option, and any asset, any securities that you can reinterpret as a call option or put option, then you can apply those techniques and figure out the value of it. Okay. For example, stock, equity, right? Stock, equity. We have limited liability feature. Okay. Limited liability. Let's say Hyundai Motors. Let's say we hold one share of. We spend $100 for a Hyundai Motors stock. Okay. What if Hyundai Motor goes bankrupt? I lose that $100 only. Nobody comes to you and bash me and say, you have to repay the bank debt of Hyundai Motors to Kookmin Bank or something, right? It's just limited liability. Okay. So for equity holders' perspective, your stock is like a call option. Your Hyundai Motors asset value may be like this. Okay. We don't know where it will stand, but this strike price we can reinterpret it as the bank debt or the debt amount the Hyundai Motors owe could be reinterpreted as the strike price. Okay? At the end of the day, the market value of Hyundai Motors minus whatever the company repays, right? The residual part, the remaining part comes to the equity holders. Make sense? After you repay whatever you owe, the residual part is what goes to the equity holders. So in that sense, equity of a company could be understood as a call option upon company's asset. Okay? So let's interpret it this way and apply call option formula to value your stock. That's the idea of Robert Merton in 1974. It gave us a huge breakthrough in this finance industry. All those hedge funds and then quantitative research bloomed afterwards, right? Using this kind of call option technique, mathematically really looking great, right? Equity is a call option. Another thing you can think about is what? Natural resources. If you have oil well, right? If we have only just one crude oil well in South Korea, how good it must be, right? Well, would you invest a certain amount, right, to rig this oil, right? You have the oil field over there, and then you have to rig it. For that part, you need some machines and fixed assets. Certain amounts you have to invest. Whether you go for the investment or not depends on the value of this oil reserves. That oil reserves depend on oil price. If the oil price is going so high, like $100 or something, it will be like your oil rigging business will be like a call option, and then the payoff will be huge for you. If the oil price is low, you choose not to dig it, right? You can just stay there, keep it over there. That's the option. And then apply those call option technique to this kind of valuation. That's the idea, right? So that's a brief introduction about this. We're not going to cover this one through this semester, right? And then it's much more complicated, and then people tend to make mistakes when they are applying this real option technique. In summary, while there are hundreds of valuation models and metrics around, there are only three valuation approaches: intrinsic valuation, relative valuation, contingent claim valuation. three approaches can yield different estimates of value, as I told you before. Intrinsic valuation, buy. Relative valuation, sell. Right? You have to choose one. Right? And then three approaches can yield different estimates of value for the same assets at the same point in time. Can happen. To truly grasp your valuation, you have to be able to understand and use all three approaches. There is a time and a place for each approach, and knowing when to use each one is a key part of mastering valuation. So that's that for chapter 1. Chapter 2. Or 4, right? Chapter 4, 7, 8. Now we are delving into DCF valuation, but before that, do you have any questions here? Any questions? No? Concern? All right? Any questions? No. Okay? Ready to move on? Chapter 4. Again.
That might sound stupid, but that's over 100 pages, and how many books are in?
How many lectures for this lecture notes? I think maybe fourth week of March, we will use this one. Okay? So for each class, I think we're going to spend about 30 to 40 pages of slides, hopefully. Okay? So until almost the end of this month, we're safe over there. Okay. That's it. Right. Okay. Any questions? Questions? Anybody speak up? Yes, it's on. Right. Right. And this personal question during MBA classes. When I was taking MBA finance classes, I just had in my mind, why do professors cover similar things over and over and over again? Almost half of the semester is spent for the same thing, like kappa and beta and that kind of things. Well, as it turns out, finance guys, that's because finance guys are simple. 단무지 you say, right? In this setting, like in engineering setting, you say 단무지. We are kind of similar. That's why engineering people thrive in the finance world too. Okay? What do you mean? Well, everything looks like same in the sense that the value turns out to be composition of cash flow and discount rate. So it's very imperative to have a solid understanding of these components. Okay? And then that's why we have to refresh those things, memories here again. Also, those basic fundamental building block gets repeated in different settings and applied slightly different things. Okay? That's why it looks like the same thing as appearing same as again. That means once you master this thing, you will be thriving everywhere in finance anyway, once you master this thing. Okay? So, let's go. Discounted cash flow valuation, the basic. I show you again here, but one thing to tell you is that cash flow, 1, 2, 3, 4 to the end, right? Those things are expected cash flow. Expectation note, I just omitted to not to strain your eyes, okay? Now what does that mean? You should have some estimate about the economic state of, let's say, state of nature as A and B, or right, A and B. State A, state B, and then there would be some probability for state A and B. Is that right? Economic boom, recession, the probability you will have it. For each kind of cases, what's the expected cash flow? and then cross multiply and sum it up. That's the expected value, right? So we omitted this process. On average, it looks like this. Okay, that's the idea. Number two, that means at a certain point, you will get back to this probability discussion later on. Okay, and then have to figure out. Have to impose a certain probability of distress versus not distress. Okay, and then multiply your cash flows and then get to the expected value later on. You should be ready for that kind of things. Expected value, expected cash flow. Okay, that's the important one. And then your job is to discount those expected future cash flow with relevant cost of capital, right? Discount rate, R, right? For an asset to have so two things come in mind. One, for an asset to have value, the expected cash flows have to be positive for some time over the life of the asset. Okay? If the future cash flow is going to be negative all the way down, what's the purpose of doing valuation in any case, right? And then second proposition, assets that generate cash flows early in their life will be worth more than the assets generating cash flow later stage. So it's more like a bird in the hand kind of idea. Okay? 10 years down the road, and you get no cash until year 9, and you were starving until year 9, and by the end of year 10, you're going to earn $1 million versus $1 million next year. Which one is more valuable for you? Next year, right? Sooner the better. Time value of money. Right? So that's the idea. DCF valuation, you have roughly two categories of valuation here. Roughly two kinds of categories. When you look at the balance sheet of your company, the first one is called the firm valuation. Okay, firm valuation. The second one is called equity valuation. So it's a choice between whether you will focus on asset side or equity side. In the end, your final destination will be equity part, equity side, anyway. But would you directly start with equity side of cash flow, or would you start use indirect way of starting with firm side of cash flow and then go to the equity side later? Okay, that's the choice you have to make. And then, so equity valuation. If you look at it, the equity valuation. Here the idea is let's focus on the cash flow available to equity holders. Okay, what's the typical cash flow that is available to the equity holders? Dividend. Who said it? Yeah, right. Two of you guys. Right. Dividend is the most, longest history kind of cash flow to the equity holders. Right? Perhaps the most conservatively estimated. And then, once you project those cash flow to equity holders, discounted this guy by cost of equity. Okay, that's the idea. And then get to the market value of equity directly. The alternative is free cash flow to firm. Okay, firm valuation. Okay. The idea is let's figure out free cash flow to firm. The free cash flow available to weighted average investors. What do you mean weighted average investors? Half of me as an equity holder, maybe I will hold some stocks of Hyundai Motors, and then half of me being bankers to Hyundai Motors. So maybe I will hold some corporate bond of Hyundai Motors. So I am both, debt holders and equity holders. For my kind of weighted average investors, what's the free cash flow, and then what's the discount rate? Okay, free cash flow to the firm, and then discounted at the weighted average cost of capital, we call it. by that, you will get to the market value of firm, which is firm value. Your final destination is, in any case, it will be value of equity. So what do you have to subtract from it? Value of debt. Everybody said it, so. Right, so value of firm minus value of debt. You get to market value of equity, right? And then DCF valuation, what kind of steps do we need? Well, estimate the discount rate or rates to be used in the valuation. You just have to be consistent, right? If you choose to go for equity side valuation and then figure out the discounter, free cash flow to equity, your discount rate has to be cost of equity. If you choose to go for firm valuation, do not discount it with the cost of equity. You have to discount it with WACC, okay? People make mistakes by mismatching it. Non-trivial issue, okay? And then estimate the current earnings. For the cost of capital, right? Cost of equity or WACC, you still have a choice whether you should go for nominal discount rate or real discount rate, okay? So when you're when you're valuing a company in hyperinflation countries, right? Or the countries going through financial crisis, perhaps you would choose to go for real dollar valuation instead of nominal dollar valuation. Nominal currency versus the real currency, because of the effect of high inflation rate. It's going to screw up your, right? And then estimate the current earnings and cash flows on assets to either equity investors or all claim holders, and then estimate the future earnings, cash flows on the firm being valued generally by estimating an expected growth rate in earnings, and then the future cash flow using pro forma financial statement. So the second step here, you look back in history. Okay, first look back in history to figure out how the company was doing, had been doing so far. Okay, this is necessary to understand the competence of the management, right? How efficiently has the management been doing relative to its industry peers, and perhaps those kinds of efficiency will sustain as long as the CEO sits on that seat, right? And then based on those ideas, you can project your future cash flow, right? Or if you think if you believe that the CEO will be kicked out somehow, maybe you're Warren Buffett and you have the power to kick him out, right? And then a better guy comes in and he will manage the company in a much better way, and then the free cash flow will be much higher than before. That can happen too, right? You can, it depends on your expectation about the company. So future cash flow, you can forecast it, right? And then do the discounting with your relevant cost of capital. And then try to have some idea when the fast growth will stabilize, okay? And then get the terminal value of it. And then also, you want to try both free cash flow to firm and the free cash flow to equity, and then figure out which one suits you better, okay? Choose the right DCF model for this asset, okay? So that's it. Generic DCF valuation framework. In a diagram, it looks like this. Okay. First, you need some information about discount rate. Okay, what should be the cost of capital for this cash flow, and then you have to project your future cash flow of your company, and then at some point you should estimate the terminal value, what is called the terminal value, typically at the end of the fast growth period. This is fast growing period and then stable growth period. Terminal value. be able to sell this company to the market at that point of time, standing at time t, right? What would be the value of this asset? Free cash flow that you're expecting in the stable period. That's the terminal value. Aggregate all those things and discount it, then you'll get to the value. That's it. Discount cash flow valuation. The first component that we're going to tackle is the discount rate. Okay, discount rate. By the way, you asked about the class note and where we are. I mean, how long will we spend our time covering the class notes, right? And then it triggers the idea. When you are preparing for class, if I were you, I would spend more time on the class notes first, and the refreshers also, and then move on to the textbook, and then the questions, right? And then, so that's the idea. Textbook is like a cookbook. It explains so many in detail, so many things in detail. It's good that the author is wonderful at explaining all those things, but it's nicely summarized, hopefully nicely summarized in that class notes. So first go through it, and then go to textbook. Now the discount rate, right? We have two things here. Weighted average cost of capital and cost of equity. This guy is needed when you are doing firm valuation. This is your discount rate you use in FCF model, free cash flow to firm. Cost of equity is the thing you will use when you use the FCFE model, free cash flow to equity, or dividend discount model, DDM, right? And then, as it turns out, the weighted average cost of capital has two components, which is cost of equity and cost of debt, because you are weighted average investors. So we're going to cover the cost of debt, and then also the preferred stock. Preferred stock, we're going to also cover briefly about how to do that. But before everything else, we have to focus on the cost of equity. And then if you remember your financial management 101, the CAPM model comes back to you, okay? CAPM, beta, right, beta. That'll always bother you. And then we're gonna go through that part. And it's gonna, I don't know, kill you sometimes, right? As things get complicated. But don't be scared. Let's walk through one by one, and hopefully we'll survive. And then the cost of equity has three components in it, okay? Which is risk-free rate, and then equity risk premium, and then beta. So we'll go through one by one, and then try to complete the discussion. We're going to go through the refresher note today, and then it's about the discount rate. After all, the discount rate, especially the cost of equity today, has to be composed of two things. Okay? When you are investing in an asset, at least you want to be compensated better than investing in government bond or the absolute risk-free asset, right? If I want to lend my money to my friend, somebody, right? At least I want to get compensated as much as when I invest in government bonds. This guy in government is risk-free, so you should be giving me better than that at least. Risk-free rate is my starting base. That's the idea. The more risky you are, the more discount rate I will charge. This is risk premium concept, right? And then this risk premium, how can we model this guy is the concern of this whole discussion. Okay? In capital asset pricing model, our grandpa asset pricing model, okay, works like this. Well, risk premium, you can decompose into two parts, which is market risk premium and then the beta that you multiply on it. Okay? All the things that matter to you is the market risk. Forget about the rest. we're going to talk what we mean by this. Okay? The market risk premium, that's the single most important thing that we have to worry about. And then how much sensitive is your stock relative to that market. That's the whole idea. If it is more risky, when the market is going up or down, I'm going to charge higher risk premium. Discount rate will be bumped up high. Okay, vice versa. And the finance discipline has been developed ever since. Now, so much so that people try to generalize this model. And then they say, well, market risk is not the only factor that you should worry about. Apart from market risk, market factor, there seem to be some other factors. For example, size of the company seem to matter. Small companies seem to be earning more than bigger companies. We don't know why, but that's just there. Okay. Book to market, which is relating to the characteristics of the company, being growth company versus value companies. Tech stocks, growth companies, Google, or things like that, versus heavy industry stocks that has a lot of fixed assets over there, sitting over there, value stock, growth stock. They seem to give some systematic difference in expected return, right? So those things are apart from the market risk, and then those things we can, how do you say, cross-multiply with the risk, the betas or the risk factors, and then aggregate all those things. It will be giving us more precise idea about risk premium. Okay? That's the new approaches coming up. We're going to work on this Kaplan model throughout our semester, so don't worry about this part too much. Okay? This is it. And then we'll move on to the refresher notes. Here. Kaplan. Right? Capital asset ranking model. I mean, if you are just merely looking at exam setting, for example, CPA or CFA, finance exam setting, this Kaplan turns out to be just plug and chug with numbers. Okay? RE equals RF plus beta times RN minus RF. Everybody remembers that, like machine, right? That's so easy. So why do we have to care about it? But that's easy to forget too. And then forget about why the heck we are doing it. Okay? The important thing is we have to know why this thing is as such, right? It is designed as such. The most important thing we have to think about is like risk-return trade-off and what we mean by marginal investors. And then we have to think about what capital market line means and what security market line is trying to tell us. And then things like risk in borrowing later on. Okay? Yeah. 5 minutes left. Thank you. I don't want to go over time. All right. So risk-return trade-off. All right. Before we move on further, right? Let's start a discussion about what risk is. Right? Risk. Risk. The Korean typical way of translation is what? Something you're scared about. Happy, we say risk averse. You're risk averse as a human being, that's human nature. Nobody can stop it. But in finance,